Hi, everyone. Welcome to the Bordeaux Blend, where we're blending expert opinions and tools to help people improve their everyday financial decisions. There's a lot going on in the world today, to say the least, with a lot of concern in particular about things like the state of the U.S. economy. And to aid in that discussion today, we've asked Anirban Basu, founder, chairman, CEO of Sage Policy Group, among a list of many other accomplishments, which we don't have the time to cover all today, but including one of Baltimore area's most powerful business people and Maryland's 50 most influential people, and most importantly, the economist known as the one with a sense of humor. So thank you for joining us today, Anirban. And just to start, could you give us a little bit of background just on Sage Policy Group, the things that you're focused on here in the near term, and really what the mission of you and your group is?
Right. Sage Policy Group Incorporated was founded in 2004. We have 12 people on staff, including myself, which actually makes us quite large by economic consultancy standards. We do economic research for folks, whether it's real estate developers, energy suppliers. We do a fair amount of expert witness testimony for attorneys. We do a lot of work for various membership organizations. We have a big vertical in the economics of the construction industry. My doctoral work was completed in health economics, so we have some healthcare-related clients as well. But obviously, we're just an opportunistic small firm. So when somebody, again, whether it's an energy supplier or whomever it happens to be, needs research to be done, we're happy to do it. And so that's who we are.
Awesome. Well, being kind of sector agnostic, hopefully that'll lead to a nice, well-rounded conversation for everyone today. There's obviously a lot of different places that we could start the conversation. I guess, what are the top few things that you're focused on or at the forefront of your mind now? I was listening to Dr. Lacey Hunt, who I'm sure you're familiar with, who was saying, look, I think these inflation worries are more or less behind us at this point, but at least as you're looking at things from a very high level, just for the United States, what are the things that you feel or should be in the crosshairs for everyone that's concerned about economic policy?
Well, to quote Gomer Pyle, surprise, 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 right? Because we came into the year very gloomy economically. Almost everyone was predicting recession. There's an index from Bloomberg that suggested the chance of recession was 100%. It doesn't get more than that, as it turns out. And so, and yet, here we are, speaking in quite late 2023. There's been no recession. Indeed, the U.S. economy seems to be performing quite well. Plentiful job growth, 3.9% unemployment rate through October, 9.6 million job openings as of September of this year. And so that, I think, has been the great surprise. The resiliency of the U.S. economy, including the resiliency of the U.S. consumer. The consumer stared inflation right in the face and really spent right through it, buying things like Beyonce and Taylor Swift concert tickets, often at more than $1,000 per ticket. So that's where we are. Employers also surprised by continuing to hire people, even as workers have become more expensive. But this notion that these inflationary issues are simply behind us, I think that that's far too optimistic. Because, yes, it is true that we see less inflation in the world of goods. Supply chains are much healthier, more dependable than they were in late 2021, for instance. So goods inflation has come down meaningfully. Many workers have been rehired by hotels and restaurants. And so maybe that's helped with service sector inflation, but I'll tell you, workers are becoming more expensive. And you can see that in various ways, labor flexing its muscles, whether through UAW strikes or actor strikes or writer strikes, or sometimes negotiations don't end in a strike. And let me give you a very prominent example. The 5-year agreement reached between the Teamsters and United Parcel Service, UPS. During the 5th year of that contract, the average full-time UPS truck driver will earn $170,000 per year. That's wages plus benefits, but it's $170,000 per year. Forcing people like myself to ask the question, how do I look in brown? And based on the app, spectacular. But the point is that's inflationary. So with these rampant wage pressures still with us, I think inflation could be quite sticky. I understand, by the way, that recent inflation data have been quite benign, have suggested that inflation is falling quite rapidly. But I think when you look around the economic environment, you see, my goodness, wages are more expensive, and construction firms and restaurants and hotels are paying more for those workers. Eventually, that's got to translate into higher prices, and that's inflation.
Yeah, and I don't mean to say the gist of that conversation at all was rosy. I would say that was the one thing that stood out to me against a pretty pessimistic backdrop. And in particular, one of the things that I think especially stood out is just US debt and the printing of money simply to service that debt, growth over time of that not looking spectacular, to say the least. This is to quote Dr. Lacey Hunt. I haven't done this math myself, but he suggested that, hey, based on his calculations, there's about $1.2 trillion of debt that was issued between 2020 and 2021 at pretty low rates, right? Close to 2% that's going to mature in 2024, at which point the rates will be much, much, much higher, thus exacerbating the issue. What's your take or vantage point with respect to that cost of debt that's growing so substantially, and what the downstream effects of that might actually look like in the coming few years here?
It could be quite horrific. We have a $33 trillion national debt. Interest rates are rising, of course, so the debt service on that debt will continue to expand over time. Typically when a nation faces a crisis like COVID, deficit spending goes up during the crisis as government responds to the crisis. And of course, government responded to the crisis. But here's the thing. Now the crisis is behind us. I don't see many people walking around with masks. The government is still spending such that we're generating very large financial deficits. And of course, those deficits have to be financed in the short term and the long term. We've had actually a couple of treasury auctions that haven't gone that well. As many people know, interest rates have generally been rising this year. Yes, recent benign data on inflation have pushed certain bond yields lower. That's true, but still bond yields have climbed for the most part over the course of the year. And given that we're becoming an increasingly indebted nation, given our demographics, so for instance, we're also getting older. So as an example, the Medicare Trust Fund will go insolvent in a few years, and a couple of years after that, so too will the Social Security Trust Fund. We're hurtling towards major fiscal crisis. Now, we're not Greece. What does that mean? They couldn't print money to get out of their crisis. Right? They're part of the Eurozone. And, unless the Germans gave them permission, they weren't going to print euros, and they're not, on the drachma system anymore, right? Once upon a time, they just printed drachmas, pay off their debt, and, wrote home about it. But we, of course, Americans with the U.S. dollar, and, when the debt crisis comes at some point in the next 10 to 15 years, maybe sooner, one of the things we can do, of course, is cut spending. We can raise taxes, or we can print money. What do you think the Americans are going to do? We're going to print money. We're going to pay back our creditors with devalued currency. And basically, people who are buying our treasuries now to finance our deficits are realizing America may not be good for it. And I think that's one of the reasons that interest rates are going to stay higher for longer, is because there are these concerns. This year, 2023, we've seen both Fitch and Moody's downgrade long-term U.S. debt, in part because of our political dysfunction. So lots of issues facing us. I don't think it's a 2023 or 2024 issue, but it's an issue, and it's certainly an issue for children and grandchildren.
So what does that, I suppose, help people paint a picture of that? What does that actually mean for them longer term, right? Sustained higher prices. What about, how that trickles down to the portfolio? Seems like maybe there could be some headwinds for equity markets as all of that continues to materialize. But how do you, kind of bring those 2 points together?
Right. So obviously, when you have financial market uncertainty, that's generally bad for asset prices. In this instance, for both stocks and bonds. Higher inflation, it would transpire if the Federal Reserve, in fact, I should say actually not the Federal Reserve, as it turns out, the federal government printed its way out of its deficits. Higher inflation, higher interest rates, higher borrowing costs, negative impact on asset prices. So all of this is quite negative. Obviously, higher interest rates translate into higher mortgage rates. That's bad for the housing market. So you'd see various asset classes really suffer under that kind of scenario. So that would jeopardize people's retirement, for instance. I mean, it could be a crisis that would make 2008, 2009 look like nothing. That's what I'm suggesting. A lot of economists will tell you it's coming. 2030, 2031, wherever it is, that the next cycle is coming, that doomsday cycle. And so people have to be prepared for that. I mean, what assets could they hold that would be resistant to that kind of downturn? Is it gold? Is it Bitcoin? What is it? I mean, that's something people might want to think about when they ask their financial advisor about how they should structure their portfolio for the long term. Yeah, so it could have many different effects. Obviously, it could have an effect on whether or not the US dollar remains the reserve currency, the currency in which global transactions are generally conducted. All these kinds of things are at risk. It's not a fait accompli. If we were to have some adult behavior in Washington, D.C., some financial responsibility, some movement towards a more balanced budget. And in fact, it should be noted that back in fiscal years 1998, 1999, 2000, 2001, this country was running federal budget surpluses. We can do it as a people, but we had a different group of leaders back then. We have a different group of leaders now. And they so far have proven incapable of running their affairs or running our affairs smoothly. We can see this with all these near misses with respect to federal government shutdowns and the like, going several days or a couple of weeks, for instance, without a Speaker of the House. So this is evidence of massive dysfunction. And if this dysfunction persists and these deficits persist, we're headed to crisis. So it's retirement, it's the children's future, it's the future job market, it's all these kinds of things. It's our national standing in the world. All of these things are jeopardized. And by the way, as we spend more on debt service, that means less on education, less on infrastructure, less on homeland security, less on national defense, less on our national parks, all these kinds of things. It really affects quality of life. So that's what's at stake here, the quality of life in America.
And I think you mentioned one thing that I want to just double click on for a second. And we've heard this floating around a lot is that, hey, what's the risk of the United States dollar not being the reserve currency? Who's kind of next in line? Because that's, I think, the big question if people are looking at that and saying, okay, well, what's the next best option if things aren't going to be, if the dollar's not going to be the reserve, what is? And would I rather have that? What is that in your mind?
A great question. And I've been asking that question, too, for a long time. And because of the way I ask that question, I often deliver the wrong answer to myself. Right. So here's what I mean. When you look around the world, there's no other currency that can rival the dollar. It's not the Chinese renminbi. It's not the Indian rupee. It's not the euro, which has a fairly uncertain future. It's certainly not the British pound, the Canadian dollar, the Swiss franc. It's none of those currencies. And it's not Bitcoin that can rival the US dollar. We're the best house in a bad neighborhood. And even at our worst, we remain the best house in a bad neighborhood. And so, a few months ago or years ago, I would have said, look, the dollar's just not going to lose its reserve currency status because no other currency is in line to replace the dollar. But as it turns out, the share of global transactions conducted using US dollars actually has been falling over the course of time. Not massively, very gradually, but it's not been falling with respect to one single currency. It's sort of been declining, in a very slow fashion against a group of different currencies. And sometimes because the Saudi Arabians say, well, we want to, conduct some transactions in Chinese renminbi or whatever it happens to be. It's often political in nature, some of these things. But the point is the dollar has been hemorrhaging some of its market share as the global reserve currency for years now, and we haven't had our bond crisis yet. And so if we actually have our financial or bond crisis, or deficit crisis, or debt crisis, then, of course, all bets are off. And then what could really come in to replace the dollar? It could be, the currency associated with the second largest economy in the world is the Chinese renminbi. It could be that, perhaps. It could be the euro. It could be all kinds of currencies, but it's probably going to be a group of them that would capture more market share as the US dollar lost some value. So right now, the US dollar is very strong, by the way. As I'm speaking to you, a euro can only buy $1.08 US, a British pound can buy around $1.24, one Canadian dollar can buy only 73 cents. That's quite weak by historical standards. $1 can buy 151 Japanese yen. That's quite high by historic standards. So the dollar right now is strong despite the ways in which we abuse it. But at some point, of course, we have enough rope to hang ourselves with, and we seem to be doing that. The dollar's future is precarious.
And as that relates, I say, I guess somewhat adjacent to that is just the world's interest in holding United States debt. The China's holding of U.S. Treasuries is down to the lowest since it has been in 2009. Back then it was close to 1.3 trillion. Now it's about 805 billion. What are the global impacts of that happening? You mentioned a little, Treasury auctions that fell flat on their face, but is there any concern about people who have that within their core part of their investment portfolio here being left as essentially the bag holder?
Yeah, I think so. I mean, look, if you hold a U.S. Treasury to maturity, you don't have many issues necessarily, right? So let's say I buy a 10-year U.S. Treasury. yielding around 4.5 or 4.6% as we're speaking. Let's say I do that. As long as I hold to maturity, I'm going to get that coupon payment. I'm going to get my principal back, at the end of those 10 years. But the issue, of course, is what if I don't hold that to maturity? The bond's value fluctuates over time. As investors become more and more concerned about our deficit issues, the value of that bond could fall occasionally, significantly. So that's some of the risk here. And so what happens, people say, look, I'm facing more risk when I buy a U.S. Treasury, particularly a long-term dated U.S. Treasury, a 10-year or 30-year, so on and so forth. We actually had a very weak 30-year Treasury auction recently, by the way, and maybe that's not coincidental. People said, look, I'm not sure about America's fiscal future. And so when I go out the yield curve and buy a bond of a greater duration, I'm taking a lot of risk. And because I'm taking on more risk, I'm going to demand higher interest in the interim to reward me for my patience and my risk. Well, the problem, of course, is that raises U.S. borrowing costs, which makes it more likely that the U.S. economy, or I should say the federal government, is going to run into trouble. So it's just not a great equilibrium. Again, we can head this off. We have time. We have the economic strength to do this. We need responsible policymaking in Washington, D.C. But when you have one party trying to make the other party look bad and the other party trying to make that party look bad and so on and so forth, no one can get along. And then you got Joe Manchin running around thinking about running for president. All these kinds of things going on. It's just not a stable environment to make good policy. So we've got some issues. And of course, those risks created by today's politics show up in valuations today. And you're going to see more of that, I think, going forward. So just be very careful out there as you stack your portfolio and think about the duration of your bonds and how many bonds you have in your portfolio relative to equities. And do you have gold and Bitcoin in there? Do you have foreign currencies in your portfolio? Have you bought foreign stock or equities, foreign bonds, those kinds of things? Have you bought municipal bonds? There's opportunities to diversify here, and one should take advantage of those opportunities.
And what about, we hear a lot of rhetoric, I suppose, about, soft landing. There's confidence in soft landing. I suppose two questions that stem from that. One, what does a soft landing mean to you? Because that, I think, is something that's intangible for most people. So what is a soft landing? And two, do you think that's something that's achievable in the near term?
Yeah, so great question. So soft landing. So actually, the definitions vary. The term soft landing differs according to who's considering it. So here's my definition of a soft landing. And what's the context here? The Federal Reserve, along with the rest of us, began observing this incredible rate of inflation during the spring of 2021. That's when really inflation bursts forth as the economy reopens from the pandemic in fits and starts. And in 2021, the Federal Reserve does nothing about it. They don't raise interest rates in 2021. So they let that inflation run. And it becomes embedded in people's expectations. It becomes embedded in the form of a wage price spiral. Now, on March 16th of 2022, they start raising interest rates. And they've been doing that pretty much ever since. The last interest rate increase, if memory serves, was July 26th, and maybe they've paused now and they're not going to raise interest rates anymore during the cycle. But the upper limit on the Fed funds rate, that key policy instrument, had been 0.25% before they started raising rates. The upper limit is now 5.5%. Yeah, so the notion is, well, my goodness, they're doing this, raising these interest rates to induce the American people to borrow less money and spend less money, borrow less money and invest less money. And that brings down aggregate demand in the economy, brings supply into conformity with demand, and thereby brings us closer to ultimately 2% inflation, which is the Federal Reserve's target rate of inflation, 2%. That's their measure of price stability. And they want to do all of this without, and here's the soft landing part, driving the economy into recession. Now, some people define a soft landing as, well, a mild recession is okay. We'd still consider that a soft landing. I don't. Recessions are bad. And so I would consider any recession a hard landing. Okay, so that's the definition, at least my definition. Recession is hard landing. Avoiding that would be a soft landing. Many economists are now in the soft landing camp. They think the Federal Reserve has won, that the economy has continued to expand. For instance, look at that third quarter gross domestic product number. Initial estimate 4.9% from the Bureau of Economic Analysis. That's growth. 150,000 jobs added in October, according to the initial estimate from the Bureau of Labor Statistics. That's growth. 3.9% unemployment, quite stable. The equity markets have performed quite nicely this year. All those kinds of things are indicia of economic growth. And inflation is coming down. It was 9.1% June of 2022 on a year-over-year basis. Last reading as of October was 3.2%. So, people say, my goodness, 2% is right around the corner. The economy is still growing, has lots of momentum. People are buying Taylor Swift concert tickets. What's the problem here? The issue for me is this, that the godfather of monetary economics and the godmother of monetary economics, so that's Milton Friedman and Anna Schwartz respectively, taught us that monetary policy operates with long and variable lags. And my feeling is that the complete effect of these prior interest rate increases engineered by the Federal Reserve, those impacts have yet to be fully felt by the economy. That more impact from these higher interest rates, whether on commercial real estate or construction, have yet to really impact the economy. And when that happens, that's when we're going to have a recession. So I'm still in this camp that recession is coming in the next 12 months. I'm now in the minority with respect to that. I was in the majority coming into the year. I'm in the minority now, but I still believe that there's some further economic weakness behind us because of these lag effects associated with prior rate increases. Other economists would, of course, disagree.
Yeah. Yeah. And does that have, we hear this metric thrown around a lot of money supply. People looking at, there's different economists have different measures that they prefer. M2 money supply is common, but inflation in particular, and maybe this is in line with your thoughts about this lagging effect of the Fed's response that happened, with initial inflationary pressures. Now maybe seems like they're a little bit behind the ball in terms of tightening and possibly over tightening. But is there a sense that with a declining and contracting money supply, that inflation and in particular CPI will tend to follow that over the next few months or the next year or so?
Oh, yes. I mean, that's right. I think that we are headed towards 2% inflation. In fact, if you listen to, analyst reports about Walmart and so on and so forth, in some categories, they're experiencing not just disinflation, not just lower inflation, but deflation, actual falling prices. I mean, we've seen prices of eggs, for instance, fall about 71% since the 2022 peak, that kind of thing. So, yes. But I believe that one of the reasons you're seeing less rapid price increases, or in some cases price decreases, is because the economy is slowing quite quickly now. And there's a number of reasons for this. There are a number of reasons for this. One, the consumer is tapped out in many cases. It appears that the bottom 50% of U.S. households in terms of income have spent down their pandemic era savings. And they are taking on lots of credit card debt to try to maintain their living standards and still paying quite high prices, in some cases rising prices. Businesses seem to be pulling back on some of their expenditure growth. For much of this pandemic recovery period, the mantra among many CEOs was, let me chase demand. I mean, there's lots of unmet demand out there. The economy is coming back very, very quickly. If I hire the workers, lease the equipment, purchase the equipment, lease the warehouse or flex space, I expand my capacity to supply to that market. I win that market share. And in an inflationary environment, I can monetize that market share. As it turns out, corporate profits are positively correlated with inflation. But now more CEOs seem to take a different attitude, my goodness, of taking on too much inventory, too many workers. We've seen layoffs at Amazon. We've seen layoffs at Meta and many other companies. And so you could see more of this going forward because employers are dealing with these very rapidly rising costs, not just the wage bill, but also property and casualty insurance, healthcare costs, workers' comp, those kinds of things. It's adding up. And of course, to grow an enterprise means often to leverage the balance sheet. But leverage is more expensive now because interest rates are higher. So maybe the pathway to profit maximization is not growing the enterprise, but by shrinking certain cost segments. So in any case, that's why I continue to think that recession is in front of us. But look, I've been amazed that the economy has been so resilient thus far. I have to admit that. In 2023, the economy proved to be much stronger than I had anticipated. So I might sound like the boy who cried wolf or the man who cried wolf. I said recession was coming in 2023, and now I'm saying what? 2024? Yeah, that's exactly what I said.
Yeah, we hear that at least on a weekly basis. It's the most anticipated recession that hasn't actually happened. But what else do you like to look at, I suppose? You wake up in the morning, what's on your dashboard? What are the things that you're looking at that I suppose, for listeners that are interested, what are some of the things that they can at least keep a finger on the pulse with outside of just the headlines and Wall Street Journal that may grab their immediate attention if they'd like to dig deeper? What are some of your more favorite measurements to take a look at?
Look at leading indicators, right? You look at those historic leading indicators at the Conference Board's index of leading economic indicators, which is suggesting the economy is going to weaken further. I look at measures like business inventories. When I see wholesale inventories rising, that often means that those middlemen and middle women, those distributors are having a tough time moving that inventory. They end up ordering less from manufacturers. I don't know if you've seen the most recent, or your audience has seen the most recent data from the Institute for Supply Management, that Purchasing Managers Index. It suggests that manufacturing in this country is presently in contraction, because we're dealing with these excess inventories. Now, some companies have really dealt well with their excess inventories, like a Target, so on and so forth. Walmart seems to be doing well with this. These are really incredibly managed firms, but most firms don't have that level of superior management and data analysis capacity to manage this inventory. And so it's still an issue out there. I look at all kinds of other things, leading indicators, transportation indices, so on and so forth. My sense is that, and I spoke recently to a group of tourism or visitation professionals from around the country, and they said they see things softening a bit recently. So, I look at various leading indicators, and they tell me still that the economy is set to weaken. And by the way, the yield curve, another thing I look at, is inverted. And inverted yield curves preceded virtually all prior recessions. So the 1970 recession, 73, 74, 75, the 1980 episode, 81, 82, 1990, 1991, the yield curve inverted. In all of those cases, the yield on the 1 year, for instance, was above the yield on the 10 year, just before the recession began, 2001, 07, 08, 09. And we have that situation right now. And so I think recession's coming because the leading indicators I rely on are saying it is coming.
Yeah. And I think, to further elaborate on that, there's a certain dynamic that has tended to happen in previous recessions where yield curves start to normalize, right? And this one in particular was one of the deepest, if not the deepest, yield curve inversions in history, though there's this anticipation that, hey, now, as you said, with the recent CPI print being at 3.2, we're expecting maybe rates to come down a little bit. The expected hikes that were maybe going to happen this year, futures market saying basically that's off the table. And instead of being, closer to summer, we might expect to cut a little bit sooner, maybe around May timeframe. I'm sure that will likely change as we get closer to that date. But regardless, the expectation is that maybe shorter term rates will come forward sooner. That yield curve might normalize, so to speak, a little bit sooner. And in general, or historically, I should say, when that normalization tends to happen, usually, immediately precedes some pending recession when that does happen. So who knows the exact date, but that seems to be, a dynamic that is fairly consistent over the years as well.
Clearly, I don't know the exact date. I've had some economists on my staff, and they tend to be millennials, younger economists, who have become quite smug and smirky because they've been saying recession's not coming. Right? These are young people. They have not seen cycles before. They're naively optimistic and so on and so forth. But the fact of the matter is the economy has proven much stronger in 2023 than I expected. And so they conclude that they must know something. And I hire them because I think they know something, but it's hard to predict the economy under any circumstance. That's exactly right. So the inverted yield curve. So for instance, when the yield on the 1 or the 2 year treasury is above the yield on the 10 year treasury, as an example, that predicts the recession. And the recession often begins as the yield curve uninverts. And, as I'm speaking to you right now, the inversion is about 85 basis points, 0.85%, meaning the yield on the 1 year is about 85 basis points above the yield on the 10 years I'm speaking to you. So if the Federal Reserve reduces rates, let's say 3 or 4 times next year, 0.25% each time, then at some point next year, we have the yield curve uninverting as those shorter term yields come down to meet where we are in the 10-year Treasury yield, for instance. And so that would mean that at some point in the next 12 months, some point in 2024, recession begins. That's my prediction. And I could prove to be wrong, and then my hope is no one remembers what I said. But that's, based on history, that's what I think is going to happen. Yeah.
I'll send you a note. I'll record this and make a note and come back to you. We can rehash.
Just say no. Please don't do that. Yeah. If I'm wrong, I don't want to be reminded that I'm wrong. I know I'm wrong. I just don't want people to know that.
I want to shift gears quickly and just talk about the housing market. I feel like this has been a big component. Obviously, when rates were so low, buying was going crazy, prices were going crazy. Here in the Bay Area in particular, prices were exacerbated, right? People were waiving all contingencies, paying some huge amount cash over asking, but that being near and dear to people's hearts, I feel like is always in the center, not to mention that's obviously a huge portion of inflation and other measures that we like to look at. But active listings have been jumping, somewhat irregularly. If we look across the last 10 years, October in particular is a time frame where those levels are maybe a little bit lower, though now that's jumped up a little bit, especially in light of some people being in a remote environment and being told to return to the office. I saw something yesterday that was just to say, hey, look, roughly 10% of some of these homes being sold are people that were remote working and now have been asked to return a little bit closer to the home base. But while mortgage rates are still close to 8%, first time since 2000, that could be a significant point, as you mentioned earlier, of contraction and a pain point for especially the population across the United States. What is your sense of what's going there now, and how much of a contributing factor could that be to some broader economic slowdown, or if that recession does come, how much that could exacerbate things?
Well, you know what? Here's the odd thing. A recession could be quite good for the housing market. So how is that possible? People are losing jobs, unemployment's rising. Yeah, that's true. And those things, all things being equal, are negative, but all things are not equal. So what is it that has this housing market locked up right now? It's those high mortgage rates. For buyers, and you can see it in mortgage applications are down more than 80% since the 2021 peak. What's happened here is those millennials, in particular, those would-be first-time buyers, have subtracted themselves from the housing market. They're not in the market right now. They're not looking to transact. I mean, often the home purchasing process begins with a mortgage application. That represents one's that reflects one's desire to transact, to purchase. But right now we don't see a lot of mortgage applications, and so that's on the one hand. On the other hand, there are also not a lot of people who want to sell their homes right now because they're sitting there. I mean, if you're in San Francisco or Kenosha, Wisconsin, or Cleveland, Ohio, or Fort Lauderdale, Florida, I don't care where it is. You're sitting there with a 2.75% 30-year fix. Where are you going? You're not going anywhere. You don't have to be carted out of that house. You're going out of the house on an ambulance. So you don't have many buyers out there right now. I mean, you have some wealthy people who are buying, right? All cash deals, that kind of thing. They don't care about mortgage rates. Or they're so wealthy that 7.5% on a 30-year fixed mortgage is not a big deal. They used to pay 15%. Who cares? But, for those younger buyers, those would-be first-time buyers, they really care. But with the inventory so low, what you have is a lack of transactional volume. And who's really suffering? It's those realtors and title insurance agents and so on and so forth, because they're not spending much time at the settlement table. Now, a recession would actually bring down mortgage rates down more quickly. And that's what's going to take to really unlock this housing market. That's when people start saying, okay, maybe I should sell my house now because, I'm not going to ever get back to 2.75% on 30-year fixed or 1.99% on a 15-year. But at least I can get a mortgage rate that won't cause me to suffer unduly, especially if I'm downsizing, for instance, a home. I'm a baby boomer, I'm downsizing, whatever happens to be. And you're a millennial, you're saying, okay, fine. I would have loved to have bought when the 30-year fixed mortgage rate was less than 3%. Maybe I can't get back there. But I now have the wherewithal with these lower mortgage rates than, let's say, 7.5% at some point in 2024 to buy. So a recession brings interest rates down more quickly and then unleashes the marketplace in terms of that pent-up supply, that pent-up demand to sell, and that pent-up demand to buy. So in any case, I would say that the outlook for realtors is actually quite good within 18 to 24 months, because at some point, I think we're going to see a lot of transactional volume. And that's what it's going to take, but we're not there yet. And so just people sitting in place, some are renting apartments, some are just sitting in their house saying, I don't like this house, I don't love this house, but man, I love that 2.75% or 3%, whatever happens to be, 30 fixed mortgage rate. I'm not going anywhere right now. So, we will see. If I'm wrong and there is no recession, what does that mean? That means mortgage rates stay higher for longer. And that means that people are locked up in various ways, maybe in 2026. Who knows the timing on this? But actually, recession might be quite good for the housing market.
Yeah, I think across assets too, right? I mean, it's a healthy part of the cycle. I mean, when we had just this exacerbated money printing and we had zero interest rate policy and easing that just took hold of everything, right? I mean, that was why you mentioned Bitcoin, but, crypto assets, some of which were just pure speculation, shooting through the roof, things like that. A reset is absolutely healthy. It's, of course, as you said, something that's basically impossible to time for the unfortunate few that get lucky once and then, chase that golden goose forever. That never ends up happening again. Can be a little bit of a death spiral. But What do you tell yourself? What's the counterfactual that you try to internalize? Because I think for all of us, we have some prevailing thoughts. What are the things that you're thinking about, maybe some of those counterfactual things we talked about, that might lead to a soft landing or lead to what your current expectations are changing over the next few months?
Look, you can't have a recession unless the consumer participates, because the consumer is around 70% of aggregate demand. So as long as the consumer is spending, employers are hiring, and that creates a virtuous cycle, because when employers hire, that of course leads to more spending on the consumer side of the economy. And that's where we are right now, the virtuous cycle. So to predict a recession, you have to predict the end of this virtuous cycle. And, we were talking about it, before we actually started recording, or at least somebody was. Economists have successfully predicted 9 of the past 5 recessions. That's right. We have a tendency to overpredict recession. And it's often said about the American consumer, never stand between a consumer and a cash register, right? The consumer loves to spend, and that's what they've been doing. But here's the thing. At some point, they run out of steam. Last reading was we have $1.08 trillion in credit card debt outstanding in this country, all-time high. It's been surging recently. Pandemic-era savings have been spent down. And there are some indications based on initial claims for unemployment insurance and continuing claims for unemployment insurance that the labor market is starting to slow down. So we see weaker job growth because businesses have taken on lots of costs. But then we see less income growth, and consumers are already tapped out in many cases. At least on average, the bottom 50% of consumers are. So I think consumer spending is going to really slow in 2024, enough to drive us into recession. But if I'm wrong about that, if the consumer continues to find ways to spend, if employers continue to hire people as aggressively as they have been since, let's say, December of 2020, which is the last time we lost jobs on a monthly basis as a country, then I'm going to be wrong. We're going to have a soft landing. Jerome Powell's going to look brilliant, and I'm going to look like a fool. But again, my hope is people forget or forgot what I said.
We'll scrub that from the record. How important do you think, in line with that consumer spending, is this holiday season? We're sitting here middle of November, right? We're going into things like Black Friday soon. Anecdotally, right, it seems like some companies, you mentioned Walmart earlier, are trying to pull some of those sales forward. I don't know if that's simply just for competing market share, or they're a little bit worried about consumer spending broadly. But are you placing a little bit more emphasis on this season in particular, as people are looking to a little bit more insight as to how strong consumer spending is or isn't?
I think the economy is more fragile than many people realize. And I think these large retailers like a Target and Walmart realize that. They don't want to exit this holiday shopping season with too much inventory. So they're working really hard to manage down that inventory. Target has had enormous success recently doing that. But that's sort of the problem. If you enter next year with too much inventory, you got a problem. You got a real problem because, whatever you purchase for inventory probably cost you a lot, right? Because we still have supply chain issues out there, so on and so forth. Tariffs on Chinese goods, whatever it happens to be. So things are more expensive than they used to be for a variety of reasons. Workers more expensive. So that's in your inventory cost. If you can't move that inventory quickly, you got a problem here fiscally or financially. So I think what you're going to see is a ton of discounting this holiday shopping season. And that's going to keep merchandise moving, those discounts. But retailers, as a practical matter, don't love to discount merchandise to move it. They like to charge full price. Right? That inures to their profit margin. And so that's one of the reasons I think you're seeing some sluggishness in new orders for various things, is because people don't want to be stuck with excess inventory going into next year. And if people aren't ordering new inventory, then that, of course, affects production and job creation, so on and so forth. And again, all of this is part of the recession forecast that at least I have for next year. But my goodness, this whole year, the economy's outperformed my expectation. And so is it conceivable that 2024 will bring more of the same? It is conceivable, particularly because at some point next year, interest rates are going to start coming down, right? The U.S. economy has dealt with these higher interest rates, rising interest rates in 2023. In 2024, not only do we enter the year with momentum, but interest rates might be falling at some point next year, which obviously gives a push forward. It's a tailwind for the economy. So I'm really scared of being wrong, by the way. It's a weird thing. It's like playing fantasy football. I'm from Baltimore. I'm a Baltimore Ravens fan. It's like having a Pittsburgh Steeler on your, fantasy team at a wide receiver position. You're rooting for that Pittsburgh Steeler wide receiver, but you want them to lose very badly. maybe even be injured. And so it's the same thing. I want the economy to do well, but I've been predicting recession, so I sort of want a recession. And it's put me in a very awkward position.
Yeah, understood. I think for those of us too, I hate to say we're in the same boat, but we are. Where you're always rubbing your hands, waiting for what the next solid discount looks like on assets that you would really value buying. Where maybe especially towards the end of 2021, things were just looking sky high, and it's like, okay, what do we do at this point? I think just to shift gears here slightly, there's something that I've seen a number of people, especially macro investors, things like that, referencing, but wanted to get your take on it as well and think about maybe the validity of some of these things. But there's a platform called Trueflation. I'm not sure if you've seen that. I love the idea in concept. I suppose we'll see with time whether this actually pans out or not, but they've basically deconstructed the different components that make up CPI. And to the degree that there's some market-based proxy or commodity or something like that they can use to update on a daily basis and hopefully give a better sense of how things stand on that front. And maybe that's useful as it pertains to our conversation about maybe inflation coming down or the economy slowing maybe a little bit faster than expected. But what do you think about those things? Is it just kind of, hand waving, or do you think that, that's something that may soon be a core component of what decision makers are actually using in their forecast and analysis?
Look, the more granular the analysis, the better, of course. But at the end of the day, it's really a big picture issue, isn't it? Because the Federal Reserve's target is 2% inflation. It's not, that eggs are 3% and housing's 1% and the components, work out in a certain way. It's 2% overall. However we get there, it's 2%. And, they will move interest rates based on the performance of inflation writ large against that 2% benchmark. And so, if you break down CPI, one of the components that's been bringing down inflation recently is that shelter component. That shelter component is about a third of the consumer price index, and apartment rents have been falling in much of the country recently. Because we have a lot of apartments under construction right now in this country. They're being delivered in the marketplace. And so all that new competition for renters is bringing down asking rents or actual rents. And that's steadily being reflected in the CPI data. That's what the Federal Reserve is looking at. It might be interesting that the price of eggs has fallen 71% since the 2022 peak, so on and so forth. But at the end of the day, it's 2% inflation. It's big picture. So at some level, maybe, being granular is great. You talk about some interesting facts. You can talk about softwood lumber and natural gas and so on and so forth. It's great. It makes one sound very smart. But the Federal Reserve is saying, I want 2% core inflation. That's what I'm looking for. Big picture. And so that's why I focus on the big picture here. And I still think that, we've had some really benign inflation numbers recently. Fantastic. I get that. Consumer price index data, producer price index data, all signaling the same thing. And the equity markets rallied over the most recent releases on inflation. I get that. However, one has to admit that we still have those wage pressures. And therefore, you have lots of service sector inflation still embedded in the economy. I still think that that's going to show up in future months and indicate that, my goodness, we at the Federal Reserve have to, keep the foot on the brake a bit here economically to get back to 2% inflation, because this labor market is still too hot to allow us to get to 2% inflation smoothly. So again, I would agree with many that say the Federal Reserve is done raising rates, but I would disagree with those who think the Federal Reserve is going to reduce rates massively next year. I just don't think they have the room to do that.
Yeah. A little bit more margin that we did have to play with though previously, which is nice should they need to cut rates. I think, one thing that I've become increasingly focused on is just information flow, and there's huge value there. What are some of the things that for people who want to do some exploring on their own, any sort of newsletters or podcasts, things like that you're a big fan of that maybe we can pass on to listeners as well?
Well, I'm a big fan of my own newsletter, I got to tell you.
Tell us about it.
Well, it's www.sageecon.com. Have 12 or 13,000 subscribers, something like that. We started about a year ago. And our goal is that you look at our newsletter for 5 or 10 minutes a week, you know what's going on economically. Now, we offer more than that. If you want to get more in depth, you can, but Give it, 5 or 10 minutes a week, and you'll be the hit of the cocktail party. Absolutely. That kind of thing. And also maybe have some insights that help you with your own decision making, whether it's with respect to your household or your enterprise. So, that's one of my favorite. There are many podcasts out there and many others that I look at occasionally. Odd Lots is a podcast that I routinely visit, so on and so forth. There are others. Certain economists I like, Tyler Cowen and so on and so forth. But, I read The Economist magazine, of course, every week. It's a 4-hour lift, but it's worth it ultimately to know what's going on in Chad or Uganda or in southern Argentina or whatever it happens to be. And so, I think there's some excellent business journalists at the New York Times. I watch Bloomberg television all the time. I mean, you should see me in hotel rooms when I'm giving a presentation next morning. I might be in a Tucson or a Las Vegas, someplace like that. And then here comes Bloomberg Daybreak Asia. And I'm so excited. The Chinese market's open up. The Thai market's opening up. I'm like a kid in a candy store. So, there are lots of places to look. But again, www.sageecon.com if you want bite-sized morsels with respect to economic intelligence. We offer that. Very digestible.
Wonderful. Well, everyone, be sure to check that out, sageecon.com, as well as Anirban has some other recordings and things like that you can listen to, which I certainly dove into as well, just by searching his name in Apple Podcasts, for example. But Anirban, we really appreciate the conversation today. I think giving people a lot to think about. I'm going to subtly keep your prediction for next year, and you'll hear from me soon about that. But thank you again for joining us today.
If I'm wrong, then please destroy this recording. Just destroy it.
I will.
Like a Mission Impossible, burn it up. But if I'm right, then of course, just release it widely as widely as possible. Thank you.
Done. Your wish is my command. Thanks.